Okay, let's continue with the discussion. In the previous session, we were doing leverages. What we learned here is leverages basically mean the reward which an organization is going to get is going to be disproportionate to the efforts being taken. So, if I take 10% extra effort, reward can be extra 40-50%. And if I take 10% less effort, the reward can go down by 40-50%. Effort is basically the sales level of an organization, and reward can be PAT or EPS. This arises due to operations, operating leverage, also called as business risk. Operating leverage is called business risk, and capital structure, which is financial leverage or financial risk and business risk. Operating leverage arises due to fixed cost in the cost structure, contribution by EBIT, percentage change in EBIT by percentage change in sales. One by MOS I'll explain in today's session. And interpretation is OL basically means if OL is 2 times, sales go up by 1%, EBIT will go up by 2%, EBIT will change by 2%. Financial leverage is arising due to fixed capital in capital structure, and that is fixed cost in cost structure. Formula EBIT divided by EBT minus PD divided by 1 minus tax, or percentage change in EPS divided by percentage change in sales. And this means that if EBIT changes by 1%, EPS will change by 2%. Combined leverage is multiplication of the two. One is OL into FL, or numerator of OL contribution, denominator of FL EBT minus PD divided by 1 minus tax, or this measures percentage change in EPS for percentage change in sales. In order to do the question, this is the format we follow: sales less variable cost, contribution less fixed cost, EBIT less interest, EBT less tax, EAT less preference dividend, EAS number of equity share, and EPS. We also learned net fund flow. Net fund flow is nothing but PAT, add back depreciation because it's a non-cash item, and deduct equity dividend and preference dividend paid by an organization. This is what we broadly saw in the previous session. In this chapter, one important part is having some linkage with our ratio analysis chapter. That linkage has to be there, and also with the marginal costing chapter. Okay, I'll do this example. This is little bit challenging example. This is there in concept book, page 38, but you can see the screen. Total assets and current liability of Vitrag Limited are 50 lakh and 10 lakh respectively. ROC is 15%. Measure of business operating risk. Business operating risk is nothing but operating leverage. Operating leverage is 3.5. PV ratio is 70%. Calculate sales. So we have to calculate sales. Let's write the format and see. Sales, right, less variable cost, contribution less fixed cost, EBIT. Sales less variable contribution less fixed cost, EBIT. We have to calculate sales. Tell me, how can I calculate EBIT here first? EBIT is the first thing we can calculate. How? Which one? PV ratio cannot give you profit. ROC, return on capital employed, is equal to EBIT by capital employed. What is the capital employed here? Total asset minus current liability. So ROC is equal to, right, EBIT by capital employed, 15% equal to EBIT. Capital employed is 40 lakh. EBIT is 6 lakh. Business operating risk means operating leverage. Use the formula of operating leverage, you will get the contribution. Use the formula of operating leverage. Business operating risk is operating leverage. OL equal to contribution by EBIT. Contribution divided by EBIT. 20 and this is 70% of sale. PV ratio 70%. How you got 21 lakh is operating leverage is equal to contribution by EBIT. 3.5 is equal to contribution by 6 lakh. Contribution by 6 lakh. Contribution is 21 lakh. What is the sales number? The slightly tricky example. Sales is 30 lakh. This you can handle only if you have an understanding of ratios, marginal costing, and an understanding of what is business operating risk. Operating business risk mean operating leverage. Financial risk means financial leverage. Total risk is combined leverage. Total risk is combined leverage. Let's see this example. X Limited has actual sales of 20 lakh, break even sales are 15 lakh, degree of total risk involved in the company is 6.5. Calculate the percentage impact on EPS if EBIT is affected by 12%. If EBIT is affected by 12%, it says actual sales of 20 lakh, break even sales is 15 lakh. Total risk means, what is the meaning of total risk? Combined leverage is 6.5. Which leverage links EPS and EBIT? Financial leverage. EPS and EBIT. EPS and EBIT financial leverage. Now I have total leverage. I need financial leverage. What is financial leverage? Is combined leverage is equal to OL into FL. How will we get OL here is using a formula called 1 by margin of safety. 1 by margin of safety. Now I'll give the logic for the formula. If you take numbers, let's take an example. Sales is 10 lakh. This is variable cost is 8 lakh and fixed cost is 2 lakh, which indirectly means break even is 10 lakh. Break even is 10 lakh. Formula for OL is 1 by margin of safety. 1 by margin of safety. Now, how do I get this 1 by margin of safety? Let's take the same number as it is. And now this company is doing 15 lakh. It is doing 15 lakh. 15 lakh variable cost will be 12 lakh. Our operating leverage is 3 times. Contribution divided by EBIT. Contribution divided by EBIT is 3 times. When I do this, I can say 15 lakh broken as 10 BP 5 MOS. 10 by 15 is 66.67%, 33.33%. So I can say operating leverage is equal to 1 divided by 33.33%. 1 divided by 33.33%. I'll get the same 3 times, which you will get as contribution by EBIT. You can do contribution by EBIT, but if data is not there, one simple formula is 1 by margin of safety. In this question, I have actual sales 20 lakh, break even is 15, margin of safety is 5 lakh. Margin of safety is 5 lakh, which is technically 25% of sales. 5 lakh is 25% of sales. Now write OL is equal to 1 by margin of safety, 1 divided by margin of safety. Margin of safety is 0.25. 1 by 0.254. Any doubts on this? How we got 0.25 is break even sales is 15 lakh, margin of safety is 5 lakh. Combined leverage is equal to OL into FL. 6.5 is equal to 4 into FL. FL is 1. That is, if EBIT increases by 12%, EPS will increase by 12 into 1.625. 12 into 1.625. If EBIT increases by 12%, EPS will increase by a higher number. EPS will increase by a higher number. 12 into 1.625 into 1.625. Any doubts in this? Clear? This three terms I have explained here. One is business risk means operating leverage, financial risk means financial leverage, total risk means combined leverage, and OL has a formula called 1 by margin of safety. Any doubts on this? Let's do the next set of questions. Let's do 12. A firm has sales of 75 lakh, variable cost of 42 lakh, fixed cost of 6 lakh, debt of 45 lakh at 9%, equity of 55 lakh. What is the firm's ROI? What is the formula for ROI? EBIT divided by capital employed. Tax data is not there. Does it have favorable financial leverage? I'll explain this as we proceed. You ignore this. If the firm belongs to an industry whose capital turnover is 3, does it have high or low capital turnover? What is the formula for capital turnover ratio? Sales by capital employed. We'll do the calculation and then say whether we have high or low. Different leverages OL, FL and CL. If the sales drop to 50 lakh, if the sales drop to 50 lakh, what will be the new EBIT? We will use the leverages understanding, get the answer and then verify it in the calculator. Which leverage links sales and EBIT? Operating leverage. So what we will do is percentage drop in sales into the operating leverage is the percentage drop in EBIT, because sales is dropping, so it is dropping by 10%, 20%. Whatever operating leverage you have, you do the multiplication, that will be the percentage drop in EBIT and we get the new EBIT. If the sales is increased by 10%, by what percentage EBIT will increase? Which leverage links sales and EBIT? Again operating leverage. So 10 percentage is given into whatever number. At what level of sales EBT will become 0? Which leverage links sales and EBT? Sales and EBT combined leverage. Sales and EBT is combined leverage. Sales will combined leverage, EBT will drop by 100%. We did this in the previous session. EBT will drop by 100%. What should be the drop in sales? If EBIT increases by 20%, by what percentage EBT will increase? Which leverage links EBIT and EBT? Financial leverage. EBT, EAT, EAES, EPS are proxy for the last item. Okay. So let's do the income statement now. Let's start doing the income statement. One little EBT. I think we will not be able to do beyond that. One little EBT. You keep doing it. Refer the screen if you want. All the numbers are readily available. Sales less variable cost, contribution less fixed cost, EBIT less interest, EBT. Then we'll go item by item, do those computation. And there's one requirement called favorable financial leverage that I have to explain. Any doubts on these numbers? Clear? Can you proceed? Any doubts on this? Below the table, first requirement was ROI. ROI is equal to EBIT by capital employed. EBIT by capital employed 27 lakh. We should ideally do into 1 minus tax rate, pre-tax, post-tax, but tax rate data is not there. Capital employed is debt plus equity. How much is the debt? 45 lakh. Equity 55 lakh. So we are generating a return of 27% into 100 to express in percentage. 27%. Any doubts on the ROI number? Clear? Then there's a second requirement which I have to explain. Any doubts on ROI number? The second requirement is, does it have a favorable financial leverage? Now listen. Nature of financial leverage: favorable if ROI greater than cost of debt, unfavorable if ROI less than cost of debt. Both ROI and KD should be pre-tax or post-tax. I'll explain. See, I have taken some money from debt guys, some money from equity guys. Debt guys gave me 45 lakh rupees, equity guys gave me 55 lakh rupees, clubbed them together, earned 27 percentage on whatever money they gave. Ideally, I should pay 27% to the debt guy as well as to the equity guy. If I pay 27% to the debt guy, 27% to the equity guy, everybody will get. So he generated 27 lakh rupee. If interest was 27%, if interest was 27%, equity guy would have got 1485, which is their requirement, 55 lakh into 27%, 55 lakh into 27%. So business is generating 1 crore into 27%. Debt guys I pay 27, equity guys also I pay 27. But question is saying debt guys we are paying how much? 9. Who will enjoy this extra? The extra will go to equity guy. So a firm has a favorable financial leverage if I can earn more than the interest paid. I can earn more than the interest paid. If for any reason the interest rate is, let's assume, 45%. Rare scenario, but if it's 45%, who will pay the penalty for this? Equity guy. They will get only 6 lakh 75, and 6 lakh 75 on their investment of 55 lakh is only 12%. They'll get only 12%. They will be penalized in case interest is higher than the ROI. In case interest is higher than the ROI, and if interest is lower than the ROI, equity guys are very happy. In this example, if you pay only 9%, equity guys will end up earning 42%. Equity guys will end up earning 42% in the end, because they are getting 2295 on a base of 55 lakh. On a base of 55 lakh. What concept says is, if you are paying more to the debt guys, penalty will come to the equity guys. If you pay less to the debt guys, equity guys will be very happy. To put it simply, debt leverage means debt. Leverage debt is good if I can earn more than what I'm paying, and debt is bad if I can earn less than what I am paying. So in this example, it is a favorable financial leverage because we are paying 9%, earning 27%. Only thing is, you have to take care both ROI and KD should be before tax or after tax. Here ROI is before tax, cost of debt is also before tax. The rate of interest 9% into 1 minus tax we have not done. Only thing is, do both of them before tax or both of them after tax. That consistency we have to ensure, both before or both after. That consistency we have to ensure. Otherwise it's very simple. Favorable ROI greater than cost of debt, unfavorable ROI less than cost of debt, and both ROI and KD numbers should be pre-tax or post-tax. Now coming back to the question, right? Company is earning, right? Nature of financial leverage. Company is earning 27% on capital employed. Interest paid is only 9%. Hence, financial leverage is favorable as ROCE greater than ROC, ROI, whatever name you want to give. So ROI is greater than cost of debt. ROI is greater than cost of debt. ROI, ROC, any name you can give. Logic is very simple. If you can earn more than what you are paying, favorable. If you can earn less, or if you're earning less, then it is unfavorable. It is unfavorable. If you're going to earn lesser than what interest you're going to pay, don't take loan. Don't take loan. Take entire money from equity guy. You will not be able to service the loan, or it can lead to problems in future. Any doubts on this? Okay. If the firm belongs to an industry whose capital turnover is 3, does it have high or low capital turnover? Calculate. Capital turnover is equal to capital turnover is equal to turnover is equal to sales by capital employed. Capital turnover is equal to sales by capital employed. What's the sales figure? 75. Capital employed is 100 lakh. Ratio is only, which basically means we have a low capital turnover as compared to the industry. They wanted our capital turnover is better than the industry or weaker than the industry. Clear? Any doubts on this? What? Okay. D to H you are going to do. I'll explain one more time. Different leverages OL, FL, and CL. Sales drop to 50 lakh. What will be the new EBIT? You have to first find out the percentage drop in sales. Increase the number of decimal so that you get the right answer. Let it be even 7, 8 decimal. It's okay. Then only you'll get the accurate answer. What is new EBIT is percentage drop in sales into the operating leverage is the percentage drop in EBIT. Percentage drop in sales into the operating leverage is percentage drop in EBIT. Then if sales is increased by 10%, percentage increase in EBIT is equal to percentage increase in sales into the operating leverage. At what level of sales EBT will become 0? You will do the combined leverage answer. EBT goes down by 100%. Sales will go down by 100 divided by the combined leverage. 100 divided by the combined leverage. Increase the number of decimal to avoid rounding off. If EBIT is increased by 20%, EBT will increase by increase in EBIT into the financial leverage. Into the financial leverage. Any doubts on this? 5 to 6 minutes for you. Start doing it. Yeah. The question had asked for different leverages of firm. So we do all the 3 leverages. I'll keep it as 3 decimal OL, FL, and CL. Operating leverages contribution divided by EBIT. Financial leverages EBIT divided by EBT, and combined leverages multiplication of the two. 1.22222 times, 1.1765 times, 1.4379 times. Then the next requirement is if sales drop, so percentage drop in sales is equal to 75 is become, that is 50 minus 75 divided by the base number 75, divided by the base number 33.33333 percentage. Operating leverage is 1 point. Percentage drop in EBIT. In EBIT is this into 1.2222. Will increase the number of decimal to avoid the rounding of gap. 40.740741 percentage. And new EBIT is equal to, earlier the EBIT was 27 lakh minus this percentage. So 27 lakh 16 lakh rupees. The EBIT is 16 lakh rupees. If you increase the number of decimal and do, you'll get exactly 16 lakh rupees. Any doubts on this? This is new EBIT for a 33.33333 percentage drop in sales. Then they are saying sales is increasing by 10%. So percentage increase in sales is 10 and percentage increase in EBIT, n into 1.2222, it is 12.22%. 12 point, they have not asked for the number, so 2 decimal is fine. 12 point, if they ask the number, I'll do 12.2222 so that I get the proper answer. Then the third part is, at what level of sales combined leverage links EBT and sales percentage drop in EBT. EBT is going to drop by 100 percentage EBT drop. Percentage drop in sales is 100 divided by 1.4379. So sales will drop by some 69.545865 some percentage. EBT will become 0. New sales is equal to, earlier the sales was, what are the original sales? 75 lakh. 22 lakh 84,060. Exact number if I want, I have to do the statement and check, but broadly 22,84,060. Then the last part is EBIT increases by 20%. EBT increase is equal to 20% into the financial leverage. The financial leverage is 1.1765. 23.53%. Any doubts on this? If they ask the number, then I'll do more decimal to ensure that I get the right answer. So 33.3333, 40.74, 22,84,093 is what this printed material is saying, and I had got it as 22,84,060. Depends on number of decimal we do. Here the combined leverage is worked with 6 decimals so that we get more accurate answer. And percentage change in EBT is 23.6%. Any doubts on this? Yep. Can you proceed? Let's come to 13. Let me go through the question. I will decide whether to do it now or do it after capital structure. One chapter in between was to be done. It is related to that, but let's see if we will be able to do it. Following particulars relating to Navya Limited for the year ended 31st March is given: output, selling price, variable cost, fixed cost. Capital structure as on 31st March 2021 is equity capital, reserves and surplus, 7% debenture, current liability, total is 30 lakh rupee. In that, the capital is only 25 lakh, current liability does not form part of capital employed. Navya Limited has decided to undertake an expansion to use the market potential that will involve 10 lakh rupees. The company expects an increase in output by 50%. So 1 lakh will go up by 50%. Fixed cost will also increase. Variable cost will decrease. Additional output can be sold at the existing selling price. Now, for doing this extra money, I need this extra 10 lakh. No, this part we learn it in capital structure chapter, but I think I'll be able to handle this now. But there you will learn in depth. This extra money can come from equity shares of 10 each at par, 5 lakh by way of issue of equity share, and balance by way of 6% debenture, or entirely by 6% debenture. Find out which of the above alternative would you recommend with reference to risk and return involved. Risk is OL, FL and CL. Risk is OL, FL and CL. Return is the earnings per share. Earnings per share. Return is measured through what a company is ultimately generating for the shareholder. Earnings per share. You will understand this return angle when I do in the earlier chapter. Risk angle is OL, FL and CL. So we are going to do three income statement. In the three income statement particulars, option 1, option 2, option 3. Sales will remain same. Variable cost will remain same. Contribution will remain same. Fixed cost will remain same. EBIT will remain same. After EBIT, in the first option, you have some debentures and no extra debentures. In the second option, you have some debenture and some extra debenture. In the third option, some debenture and extra debenture. So interest will be different. EBT will be different, tax will be different, EAT will be different, EAES will be different, and number of shares will also be different. Number of shares will also be different. That will give me EPS. And in the same table, we will do OL, FL, and CL. OL is going to remain same. OL is going to remain same because till the EBIT, nothing is going to change. When I said till EBIT, nothing is going to change, I'm not comparing with the existing operation. Existing comparison we are not going to do. Anyway, I'll do the existing also in the table, but my comparison is on the three options. What are the three options? First option is entirely by way of equity share. Second option is 5 lakh by way of equity share and balance by way of debenture, and third option is entirely debenture. Let's do income statement. Income statement, particulars and 4 columns. Income statement, particulars, existing, alternative 1, alternative 2, and alternative 3. Existing, first alternative, second and third alternative. We'll do the existing income statement and then make changes based on whatever the question has given. And sorry, in the table itself, add OL, FL, and CL. OL, FL, CL. Write the format. Sales till EPS, OL, FL, and CL. Let's do existing first fully and then I'll do the revised one. What is the existing unit sold? 1 lakh into 1 lakh into 40. Variable cost is 1 lakh into contribution is 20. Fixed cost EBIT 10 lakh. Existing interest how much? 10 lakh into 7%. 10 lakh into 7%. 70,000. Earnings before taxes 930. What is the tax rate given? 40%. EAES 558. EAES is 558. Any doubts on the numbers? How many equity shares are there today? 1 lakh. EPS is 5.58. Complete OL, FL, and CL also. EPS is 5.8, 5.58. Contribution by EBIT, EBIT by EBT, and multiplication of 2. Get the OL, FL, and CL. Contribution divided by EBIT. EBIT divided by EBT. Four decimals. This is the existing statement. Any doubts on the existing statement? Clear? Can you proceed? Let's do the revised statement. As I ask you, please tell me. 1 lakh into 40 was the earlier sales. Now what will be the sales? 1 lakh? 1 lakh 50,000 output can be sold at the existing price and the company expects an increase in output by 50%. 150 into 40. 150 into 40. Variable cost earlier was 1 lakh into 20. What will it be now? It will be 1 lakh 50 into 18. You cannot directly deduct 10% from the overall cost. Overall variable cost you cannot deduct. At a per unit you have to do. So any change in variable cost means a change in variable cost per unit. 1 lakh 50,000. Indirectly there is a increase in variable cost. 33, 33, 33. What was the earlier fixed cost? Extra how much? 15 lakh. EBIT 18, 18, 18. Now beyond this we have to see originally 70,000 interest. Any extra interest cost is there? We'll have to see in the three alternative. Any doubts till this? Any doubts in this? Okay, now see. It says first option, I am in need of 10 lakh rupee. First option, issue another 1 lakh share. So this will not increase the interest expense. I am in need of 10 lakh. I am going to issue entirely of at par value. Par value is 10 rupees. So 10 lakh divided by 10. Second option is 50,000 shares and balance 5 lakh. Balance 5 lakh you have to pay interest of 30,000. Balance 5 lakh you have to pay interest of 30,000. 5 lakh into 6%. Last option, entire 10 lakh into 6%. Last option, entire 10 lakh into 6%. I'll repeat. Original option, entirely by equity shares of 10 each at par. Entirely by equity shares of 10 each at par value. 10 each at par value. So 1 lakh shares will be increased in the first option. So come to the number of share. Come to the number of share. Make 1 lakh 2 lakh in the first option. 1 lakh will become 2 lakh. Make 1 lakh 2 lakh. Next option, make 1 lakh 1 lakh 50. Extra 50,000 shares. Last option, leave 1 lakh as it is. No new shares are allotted. No new shares are allotted. 2 lakh, 150 and 1 lakh. Interest continues at 70 in the first option. In the second option, you have to pay extra 30,000 interest. And third option, you have to pay extra 60,000 interest. Extra 30,000 interest and extra 60,000 interest. 5 lakh equity shares, balance 5 lakh, interest is to be paid. In the last alternative, entire 10 lakh 6% interest. Entire 10 lakh 6% interest. 70,000, another 31 lakh, 130. That's all. Complete the table. You complete the table and then refer the screen. Complete the table and then refer the screen. Complete the table. You complete the table and then I'll explain. Okay, I hope you have completed. Now listen. See, they said the question nowhere is asking to calculate leverage. Question is nowhere saying EPS also. But they said which alternative would you recommend based on risk and return involved? Return point of view, I will go ahead and select this one 10.02, 10.02 highest EPS. Risk point of view, lowest lowest risk. Combined leverage measures the risk, and your operating leverage or combined leverage measures the overall risk, and EPS measures the return. Wait for some time. But what ICI said is when you're looking at lowest risk, the EPS is in fact going down from the existing level. The EPS is going down from the existing level, which people don't agree on. People don't want their earnings to go down. So ICI said if return is the focus, last alternative, and if risk is the focus, go with this. This has relatively lower risk as compared to the last. It's not much of a variation. If I was to choose, I'll choose the last alternative itself. Return point of view, last alternative. Risk point of view, first alternative is the best one. But I don't agree on that. Reason is because of EPS going down. So we go ahead and select alternative 2. This is what conclusion they made. From the above figures, we can say that operating leverage is same in all the three alternative. Financial leverage differs. Alternative 3 uses maximum debt, highest degree of financial leverage, followed by alternative 2. Risk will be maximum in these option. Corresponding to this scheme, maximum EPS, maximum risk, maximum EPS. So if Navia Limited is ready to take a high degree of risk, alternative 3 is strongly recommended. In case you want to take less risk, alternative 2 is the next best option with a reduced EPS. Alternative 1 is even lower and hence it's not recommended. The alternative 1 is lower than the existing. That's why we are not recommending it. Any doubts on this? Return is measured through EPS. Risk is measured through OL, FL and CL. CL incorporates both. CL end up incorporating both. Any doubts on this? Let's come to 14. Axar Limited has a sales of 68 lakh, variable cost ratio of 60%, fixed cost of 1632, capital comprises long-term debt, preference and equity share, tax rate at current level of sales. What is the interest, EPS, amount of debt? If a 25% decline in sales will wipe out all the EPS. They have given certain information. We'll try to put it in our format, that is the income statement. And once I put it in the income statement, I'll be able to get to the missing data. Let's start. Question 14, income statement. Let's start with the income statement, guys. Write the income statement. Income statement. Write your usual format. Once we do it, we'll get those missing data. Starting from sales, EPS. Let's fill whatever data is available and then we'll see what is the information available. How much is the sales? Sorry, 68 lakh. What's the next information? Variable cost ratio is given. What is the ratio? Sorry, 68 lakh into 60% into 60%, 40 lakh, 80,000. We get contribution 27 lakh, 20,000. Apart from that, I have fixed cost in the question. Fixed cost is 1632, 10 lakh, 8,000. Interest is one of the requirement of the question. EPS is one of the requirement. Amount of debt is one of the requirement. Apart from this, interest I don't know, EBT I don't know, tax I don't know, EAT. Preference dividend is there. 1 lakh preference shares into 1 lakh preference shares of rupees 10. 1 lakh preference share, rupees 1 lakh. Okay, rupees 1 lakh preference share. Not sure if it's rupees 1 lakh or it's a typing mistake has happened. I don't know, but I'll go with whatever. 1 lakh into 10%, 10,000. If it's rupees 1 lakh, 1 lakh into 10%. If it's 1 lakh share, 1 lakh into 10 into 10%. I don't know if there's a typing mistake in the question, but let's go with whatever word is there. Number of equity shares. Now I'm stuck with interest figure. Once I get interest, everything will automatically get over. Interest, if I get, everything else will automatically get over. But stuck with the interest figure, because if I know interest, EBT will come, tax is given, tax rate is given. What is the tax rate? Tax is given, EAT will come, preference dividend will subtract, EAES will come, EPS will come. Once I get interest, amount of, see, three requirement: interest, EPS, and amount of debt. Interest I have to calculate, EPS I have to calculate. Amount of debt is interest paid divided by 12%, 12% long term debt. How do I get interest? Interest is the missing data now. Interest is the missing data. How do we proceed? How do we proceed with interest calculation? What does the meaning wipe out all EPS will mean? Okay, so what does that further mean? Zero is right. What does it further? EPS will go down by 100%. Which leverage links sales and EPS? Combined leverage. So I'll get the combined leverage. I'll get the operating leverages contribution by EBIT, and then I'll get the FLS, OL into FLS, CL, OL into FLS, and then I use the FL formula, which is EBIT divided by EBIT minus interest minus preference dividend divided by 1 minus tax rate. Interest will become balancing figure. Interest will become balancing figure. Now, right, combined leverage is equal to percentage decline in EPS by percentage decline in sales. EPS will go down by 100%. Wipe out all EPS. EPS will go down by 100%. Sales is going down by some percentage given in the question. 25. This is the combined leverage. What is the use of combined leverage? I'll now do OL. OL into FL is CL. OL is equal to contribution divided by EBIT. Contribution by EBIT. Contribution is there in the question. How much? Or we have calculated 27, 20, 10 lakh 8. How much? 2 point. Check again. Are you getting 2 point? 10 lakh? Okay, 88. Okay. Divide by 1088. 2.5 times. Any doubts on this? OL into FL is equal to CL. OL into FL is equal to CL 2.5 FL is equal to how much? Sorry, 1.6 times. Clear? Any doubts on this? Now we'll apply the formula of FL. FL is equal to EBIT, which I know. EBT is what this will give me, minus PD divided by 1 minus tax rate. EBT will come out of this calculation. FL is equal to EBIT divided by EBT minus PD divided by 1 minus tax rate. Preference dividend divided by 1 minus tax rate. Do same answer. You can do it. I can use the formula of CL also, which is contribution divided by EBT minus PD divided by 1 minus tax rate. Same answer will come. FL is equal to EBIT divided by EBT minus PD divided by 1 minus tax rate. FL is 1.6. EBIT, which is given in the question, is our calculated is 10 lakh. For the time being, just call it as denominator. Okay, I don't want to write this formula. Later on I'll write it. Just call it as denominator. Okay, and let's know what is the denominator, and then I substitute, because otherwise when you do multiplication you'll end up making some calculation error. 10 lakh 88 divided by denominator, just call it as denominator. Denominator is equal to 10 lakh 88 divided by 1.6. 1088 divided by 1.6, which is how much? 6 lakh. Now you say EBT is equal to, sorry, EBT minus, what is the preference dividend number? What is the tax rate? Is equal to 6 lakh 80,000, is equal to 6 lakh 80,000. You will get the EBT number now. Yep, we are getting an odd answer, but can't help it. Whatever numbers they give, 694, 286. EBT 694, 286. EBT 694, 286. You put this in the income statement, interest will become balancing figure, tax will be there, everything will get over in the income statement. Any doubts on 694 to 86? Now only thing is, I am not very sure if that preference dividend number is right, but I'll go with, let's just quickly check it. The numbers are right. 694 to 86. EBT 694. Interest is balancing figure. Balancing figure. P93714. Two 208 286 4 lakh 86,000, 4 lakh 76,000. Once that part is completed, beyond that it is just a formality. 4 lakh 76,000. You have to divide by 1 lakh 50 for the EPS. 3.1733. Clear? So question wanted EPS, which is done. Question wanted interest, which is also done. Debt is interest divided by 12%. Interest divided by 12%. Because what is the borrowing figure is Borrowing into 12% is the interest figure. Borrowing into 12%. 12% long term debt. Question said 12% long term debt. 12% long term debt. Borrowing into, our borrowing is equal to 393714 divided by 12%. Divided by 12%. 32 lakh. Getting an odd number, but okay. The important part is wiping out all EPS basically mean EPS going down by 100%. EPS going down by 100%. 32, 80, 950. Clear? We are done with forward working question. We are going to do few reverse working question, which is also greater extent we have already done. Reverse working basically means leverage will be given, and using the leverage you will find out the income statement. Using the leverage you will find out the income statement, which we have already done in few questions. Few questions we have used the concept of leverage and did the income statement. Let's come to 15. Combined leverage and operating leverage are 2.5, 1.25. Find the financial leverage. Financial leverage is easy to find. OL into FL is equal to CL, and PV ratio. And PV ratio, given that the equity dividend is 2, interest is 1 lakh, fixed cost is 0.5, sales is 10 lakh. Is the tax rate given in the question? No. Let's do an income statement first, starting from sales till EBT. In the income statement, balancing figures will come. In the income statement, balancing figures will come. What is the balancing figure I want? I want contribution by sales. PV ratio is contribution by sales. FL I can do now also. FL is OL into FL is equal to CL. So let's do the income statement. Objective is to get the income statement. Sales less variable cost, contribution less fixed cost, EBIT less interest, EBT. We stop at EBT. I can even go further also if the question had tax rate. Let's fill whatever is available. What is the sales number? 10 lakh. Then I have fixed cost is 50,000. Then we have interest is, okay. I have in the question operating leverage. What is the formula for operating leverage? Contribution by EBIT. Rule is very simple. If you have contribution, use the formula. If you have EBIT, use the formula, or if you have item in between, also use the formula. I have the item in between, which is fixed cost, which is the fixed cost. OL is equal to contribution by EBIT. Contribution by EBIT. What is the OL given in the question? Sorry, 1.1.25. Contribution is X. EBIT is X minus fixed cost. Contribution is X. EBIT is X minus fixed cost. What is the fixed cost number? You will get the contribution. Problem will get over with that. That's all. How much? 2,50,000 you will get, I think. Okay, ठीक है. So no, I meant contribution. Sorry here. Contribution is equal to excess contribution 2,50,000. Contribution is 2,50,000. Excess contribution we had assumed. We complete the income statement 2,50,000. Variable cost is 7,50,000. EBIT number is 2 lakh. EBT number is 1 lakh. EBT number is 1 lakh. Financial leverage EBIT by EBT. Financial leverage EBIT by EBT or CL by OL, whatever way you do. EBIT divided by EBT. Financial leverage EBIT divided by EBT 2 by 1, or you can do combined leverage divided by the operating leverage. Combined leverage divided by the operating leverage. Same answer you will get. What's the formula for PV ratio? Contribution by sales 25%. Everything is, it is straightforward, simple calculation as long as you are clear on the linkages. Any doubts on this? Can you proceed? Let's come to 16. From the following, prepare income statement of A, B, and C. Financial leverage is given, interest is given, operating leverage is given, variable cost ratio is given, income tax rate has been given. So they have asked us to prepare an income statement. Question has data on income tax rate. So from sales till EAT, beyond EAT not possible, number of shares is not there. From sales till earnings after tax. Question 16. Three companies income statement. Particulars in three companies from sales to EAT. Will fill whatever is available. Balance will try to get it. Once you get one data point, everything else will automatically flow in. Particulars in three companies: sales less variable cost, contribution, fixed cost, EBIT, interest, EBT, tax, and EAT. What information is there in the question? Okay, right. Interest 200, 300, and 400. Sorry, 1,000. Then I also have, okay, only one information. I have FL, I have OL, I have variable cost ratio. What's the formula for OL? Contribution by EBIT. I don't have contribution. I don't have EBIT. I also don't have the in between item. Cannot use OL as of now. What's the formula for FL? EBIT divided by EBT. That's all. Nothing, no preference dividend. EBIT divided by EBT. I don't have EBIT. I don't have EBT, but I have the item in between. I have the item in between. I have the item in between. See, EBIT divided by EBT. That's all. So EBIT is, you are going to take EBIT as X. EBT will be X minus 200. X minus 200. Let's do computation of EBIT. FL is equal to EBIT divided by EBT. Company A, what's the FL given for company A? 3 equal to X divided by X minus 200. Company A. We have to do similar for company B now. Company A is 300. Once I do for one company, balance is just a formality. 300 for the first company. Company B, what is the leverage given? 4 equal to by X minus 300. 4X minus 1200 equal to X. X in bracket EBIT. The EBIT number is 400 for the second company. The EBIT number is 400 for the second company. Then the third company. What is the leverage given? 2 is equal to EBIT is 2000 for the third company. Clear? Can you proceed? Now let's come to the calculation. What was the EBIT number? First company. Okay. The now just to be safer side, once this is done, just to check 300 by 100 3 times matching, 400 by 100 4 times matching, 2000 by 1000 2 times matching. Any reverse working after you are done, just quickly check the numbers. 300 by 100, one company you check also, it is fine, but quickly check the numbers. Tax, what is the tax rate? 45, 45, 450. Now I'll be able to use OL, because when I asked earlier, you said contribution is not there, EBIT is not there, in between number is not there. Now we have OL is equal to, and this indirectly mean contribution is OL into EBIT. Contribution is OL into EBIT. Contribution is operating leverage into EBIT. So this contribution is nothing but OL into EBIT. Into EBIT. What is the operating leverage of the first company? No, operating leverage 4200. Second company, third company, fixed cost is balancing figure 4, 5, and 3 times. Operating leverage multiplied with EBIT. Clear? Okay. Now variable cost and sales is missing. Variable cost is 66 2 by 3. 66 2 by 3, 66.66667 percentage. Contribution is balanced 33.333333 percentage, 25 percentage and 50 percentage. 100 minus the variable cost ratio is contribution. So this is basically 33.33333 percentage. This is basically 25 percentage, and this is basically 50 percentage. Contribution divided by the PVR is the sales. Contribution divided by the PV ratio. All this in marginal costing. So sales will be 3,600, 8,000, and variable cost is balancing figure 2,400, 6,000, and 6,000. Doubts on this? Yep. Just one company is sufficient. Once I do that, balance is just a formality. Any doubts on this? Clear? Can you proceed? Any doubts here? Okay, let's come to 17. Company P and Q are having the same earnings before tax, same EBT. Margin of safety of company P is 0.2. Company Q is 1.25 times than that of company P. What is the use of margin of safety? Operating leverage. Yeah, 1 by MOS will give operating leverage. Interest expense is 1 lakh 50. Q is one third less than that of company P. Financial leverage is 4. Q is 75%. See, last question gave all the number. Here they are saying this is so much more, so much less. You have to do the numbers. Same requirement. It's the same requirement. Interest is given. I have to prepare income statement. Tax rate is given. PVR is given. Last question gave VCR. This question gave PVR. Let's put the income statement. Particulars, company A and company B. Company A and company B. Write the format. Okay, let's start writing whatever is available directly. We've written the format of the income statement. Company P and Q are having the same EBT. So when I do calculation, if I get one, I'll copy paste for other one. Same EBT. Margin of safety, come down below the table. Operating leverage is equal to 1 by margin of safety. 1 by margin of safety. The two companies are P and Q. Operating leverage is 1 by margin of safety. Company P 1 divided by for the margin of safety of the first company 0.2. Last question gave the OL directly. This question said no, I'll not give it directly. I'll make you do certain things and then you get the OL. OL is 5 times. Company Q no 1.25 times of what? Margin of safety is 1.25, not the OL. Margin of safety is 1.25. So margin of safety of the second company is 0.20 into 1.25 into 1.25. So denominator is into 1.25. Net you will get 5 times and 4 times. 5 times and 4 times. Clear? We'll use this information later on, but as of now, I've just read the first line and written this. Interest expenses given. Company P is how much? Negative 1,50,000. And 2 is, they said, one third less than that of P. So from 1,50,000, subtract one third. Subtract one third and tell me the figure. After subtracting, tell me the figure. 1 lakh. 150 minus one third of 150. Clear? Then I have FL of company P is 4 times. 2 is 75 percentage of P. 75 percentage of P. Next, FL is equal to company P 4 times company Q 4 into 75%. Okay, 2 minutes. Beyond this, you are going to do. Listen, the question has interest. Use the formula of FL. You will get EBIT and EBT, tax, everything will get over. Then use the formula of operating leverage. You will get contribution. Use PV ratio. You will get sales. Exactly like the previous question. Only thing is OL and FL were not directly given. Some calculation was to be done. Take around 5 minutes. So first is I wanted to use the financial leverage data for the first company. FL is equal to on EBIT by EBT. FL was 4x divided by x minus 150. X is equal to how much? I will not do the calculation for the second company. I don't need it also. Reason is do this 2 lakh 50,000 same EBT 50,000 and reverse working 150. Even if you had done x divided by x minus 1 lakh, you would have got the same answer. 150 you would have got. But question said same EBT. Same EBT, I copy paste the EBT. What the tax rate? 22,500, 22,500, 27,500, 27,500. Contribution is OL into EBIT. OL into EBIT. 2 lakh into what is the operating leverage of the first company? 5. Second company 6 lakh. Fixed cost balancing figure is 8 lakh, 4 lakh 50. Variable cost is the PV ratio is given. What is the PV ratio here? Which one is? So 10 lakh divided by 25% of sales, 40 lakh. And second company 6 lakh. It's like 33.33333 percentage. You will get 18 lakh, 12 lakh. Any doubts on this? It's exactly the same as the previous question. Just for practice, that question did not give, they gave all the numbers directly. Here you have to use the formula of the OL. OL is margin of safety, 1 divided by margin of safety. Any doubts on this? Okay, with this the chapter got over. Very simple chapter. I'll quickly revise what we had in this chapter. We started with understanding what is leverage. Leverage basically said reward is going to be disproportionate to the efforts taken. The efforts are in the form of sales, reward is in the form of PAT or EPS, and you will see a disproportionate thing happening due to 2 reasons: fixed cost and fixed capital. Fixed cost is operating leverage, contribution by EBIT, or percentage change in EBIT by percentage change in sales, or 1 by margin of safety. Interpretation is 1% change in sales, 2% change in EBIT. Financial leverage due to fixed capital, EBIT divided by EBT minus PD divided by 1 minus tax rate, or percentage change in EPS divided by percentage change in EBIT. Interpretation is 1% change in EBIT, 2% change in EPS. Multiplication of the two, OL into FL, or contribution divided by EBT minus PD divided by 1 minus tax rate, percentage change in EPS by percentage change in sales, and that's the interpretation. This is the format of income statement, starting from sales till EBIT as marginal costing, EBIT till EPS is financial management, EBIT less interest, EBT less tax, EAT less preference dividend, EAES number of equity share, and EPS. Net fund flow basically means PAT, add back non-cash item depreciation, deduct equity dividend, and deduct preference dividend. Nature of financial leverage, we have two nature. One is favorable, unfavorable, depends on ROI and cost of debt. ROI greater than cost of debt, favorable. ROI less than cost of debt, unfavorable. Both ROI and cost of debt should be either pre-tax or post-tax. Clear? Any doubts on this? With this chapter gets over.